Welcome to Fairport Flash, the monthly economic update powered by the Fairport investment team. Our team gathers the most recent news, data, and research and distills it into the information most important to you. Let's get started.
Welcome to the March 2022 edition of the Fairport Flash. My name is Rick D'Amico, Manager of Investments at Fairport Wealth. As a member of the investment team, I'm responsible for managing the firm's taxable and municipal fixed income strategies, as well as Fairport Wealth's liquid alternative investment models. So let's get started by discussing a very difficult situation, the war in the Ukraine and its impact. Aside from the most important aspect, the human toll this is taking, the war has led to high spikes in commodity prices, as well as sharp declines in the equity markets. Since the start of the year, crude oil has jumped from $76 to $117. And looking at the trend in retail gasoline, it may not be long before we see $4.50 at the pump. In addition, the longer the war carries on, the more disruptive it will be to the supply chain, potentially resulting in even more broad-based price increases on a global basis. This certainly doesn't bode well on the inflation front, with headline CPI likely on track to increase over 8% in March. Our base case did call for inflation to cool towards the second half of the year, but given recent events in the Ukraine, it is now looking like inflation will be more stubborn than we had initially anticipated. We've also seen a strengthening dollar driven by the safe haven flows into U.S. assets. Past evidence during similar crises also supports the case for a stronger dollar going forward, as the U.S. dollar appreciated significantly against both emerging market and developed market currencies during the financial crisis and at the onset of the COVID-19 pandemic. If the past holds true, a stronger dollar could also be one factor which restrains the Fed this year. In our view, the Fed is unlikely to increase rates the 5 to 6 times the market has priced in for this year. And as long as geopolitics represent a risk to the U.S. economy, the Fed is more inclined to go slower than previously anticipated, most likely moving in 25 basis point increments over the next couple meetings. Powell made an unprecedented move at last Wednesday's congressional testimony, stating that he is, quote, inclined to propose and support a 25 basis point rate hike, unquote, this month. Powell basically front-ran the March 16th meeting by all but pre-announcing the Fed's decision, something that has rarely occurred throughout the FOMC's history. It is assumed that Powell made the move primarily because, one, he has the strong support of a majority of the committee, and two, because he's about had enough of the noise being constantly generated by a couple FOMC members. Chairman Powell probably also recognizes that the downside risks of the war in the Ukraine most likely outweigh the benefits of fighting inflation more aggressively. So even though the Fed will begin the tightening cycle to try and help bring inflation under control, it will do so cautiously given the situation in the Ukraine and the possible spillover effects to the U.S. economy. As of now, the U.S. economy appears healthy, still benefiting from the unprecedented amount of monetary stimulus in the system and Omicron seemingly in the rearview mirror. Evercore ISI's company surveys, which are reflective of company revenues, remained in solid territory after recently surging to record high levels. U.S. nominal growth also appears robust. The fourth quarter consensus for S&P revenues has increased to a 28% quarter-over-quarter annual rate and a 14% expected increase year over year. Other evidence pointing towards strength in the domestic economy includes an 11.5% jump in nominal wages and salaries, which is responsible for helping to drive the 13.8% increase we've seen in nominal consumer spending. There's also strength being driven by the acceleration in bank loans as well as home prices. So what are the odds that the war in the Ukraine does eventually derail the strength in the domestic economy and lead to a recession? According to Stan Shipley's analysis at Evercore ISI, the capital markets put the probability of a recession in the next year at around 23%, which is up from an average reading of 14%, but not cause for concern at this point. That being said, the sharp increases in commodity prices are flashing a recession signal, but it is important to note that past recessions have been preceded by a significantly higher level in the Fed funds rate, typically north of 5%, and a yield curve that is sharply inverted. This time could be different, but the Fed funds rate is still anchored at 0, at least until the next meeting, and the slope of the U.S. yield curve, while having narrowed significantly, is still in positive territory by 23 basis points. Another key signal worth monitoring is the level of credit spreads, especially if they continue to widen. While they remain well contained when compared to historical averages, the recent widening does signal somewhat weaker growth going forward. As such, Evercore ISI has lowered their growth estimates by 0.5% in the second, third, and fourth quarter of this year, down to 4% in the second quarter, and down to 3% in Q3 and Q4. So what does this mean for equities going forward? Given the large amount of uncertainty that exists, the war in the Ukraine, inflation, and midterm elections? As Renmac Research points out, the technicals do suggest near-term headwinds for the S&P 500, as their trend model has entered a zone that suggests caution. In addition, the S&P 500 has been putting in a series of lower lows and lower highs, which is not typically what you like to see from a technical standpoint. If you are looking for a light at the end of the tunnel, geopolitical events tend to be short-lived as headline risks do dissipate. Vanguard recently noted that going back to the Cuban Missile Crisis in 1962, markets tend to average a positive return of over 9% 1 year after the geopolitical event. And while there is potential for spillover issues from the economic sanctions, remember Russia represents less than 0.5% of the MSCI All-Country World Index. In comparison, the U.S. makes up approximately 60% of that index. Volatility is likely to stick around for the remainder of the year, as equity markets typically experience higher volatility in midterm election years. Going back to 1950, the median correction during a midterm year is negative 16.3%, but rebounds have been sharp as well, with a median return of 33.5% 1 year later. Fixed income investors are also in a tough spot, as yields are supported by a recent flight to quality, but at current yield levels, 1.9% on the 10-year, they still offer very little protection against inflation. From a technical standpoint, short-term support on the 10-year Treasury can be found at 1.4%, while resistance can be found closer to the 2% level. We remain underweight duration relative to the benchmark, as our base case still calls for rates to eventually grind higher. We are also overweight credit, but not to the extent we have been pre-pandemic. We will continue to monitor investment grade and high yield credit spreads, as their recent spread widening is a concern, but as noted earlier, both sectors are still below their historical median spread level. This brings us to the conclusion of this month's edition of the Fairport Flash. As a reminder, our goal at Fairport Wealth centers around inspiring families, and as a member of the investment team, we strive to do this through a long-term and diversified approach. While it can be difficult in uncertain environments such as this, we believe it is even more important for clients to be patient and stick to their long-term plan implemented by their advisor. If you would like to further discuss any of the topics covered in this month's Flash, please reach out to your Fairport team. Thank you again for listening, and as always, we are grateful for all the relationships we have with our clients and for the trust you have placed in us. Keep an eye out for the next Fairport Flash in about a month.
Fairport is a group of investment professionals registered with Hightower Securities, LLC, a member of FINRA and SIPC, and with Hightower Advisors, LLC, a registered investment advisor with the SEC. Securities are offered through Hightower Securities, LLC. Advisory services are offered through Hightower Advisors, LLC. This is not an offer to buy or sell securities. No investment process is free of risk, and there is no guarantee that the investment process or the investment opportunities referenced herein will be profitable. Past performance is not indicative of current or future performance and is not a guarantee. The investment opportunities referenced herein may not be suitable for all investors. All data and information referenced herein are from sources believed to be reliable. Any opinion, news, research, analysis, prices, or other information contained in the research is provided as a general market commentary. It does not constitute as investment advice. Fairport and Hightower shall not be in any way liable for claims that make no express or implied representations or warranties as to the accuracy or completeness of the data and other information, or for statements and errors contained in or omissions from the obtained data and information referenced herein. The data and information are provided as of the date referenced. Such data and information are subject to change without notice. This document was created for informational purposes only. The opinions expressed are solely those of Fairport and do not represent those of Hightower Advisors, LLC, or any of its affiliates.